Today I would like to talk about LVMH. So they are one of the biggest luxury companies in the world, and they own many famous brands that you probably know. So the first thing they own is Louis Vuitton, Christian Dior, Givenchy, Fendi, Celine, and many other brands. Also in the beverage companies they own, Hennessy and other famous brands in wine and other things too. So they have a big portfolio. They own many different brands. And the interesting thing is that they had a decline over the last year. So they are down 22%. And from here they are, 26% down. So they had a big decline. So the question is now, is the company undervalued or fair valued or even overvalued? So we have to take a look in the financials to find out. The first thing we can notice is a big market cap of 317 billion euro. So this is actually a very big company already. It could mean that they will have more difficulties to grow in the future because they're already so big. Let's take a look at the financial foundation. The first thing we are looking for is revenue growth over the last 5 years. And if we take a look here, we can see that the revenue did grow, and in a very good way actually. At some point over 43% and 23%. So of course we had a decline in COVID in 2020, but since then it did grow in a good way, and that's a check here. We also would like to have the free cash flow to grow over the years, because this is how the company pays the dividend and also can buy back shares. So we can see here as well, the free cash flow did grow over the years, and the best year was in 2021, and then we also had a decline for 2 years. So that's still a check here. We also would like to have the free cash flow yield over 4%. This can also indicate the valuation of the company. So if it's under 4%, it could be overvalued, to me at least. So we take a look here, we see the free cash flow 11.6 billion. And now we divide it with the market cap. So then we get 3, 9. Okay, this is about 3.659%. So it's under 4%. This could indicate a little bit overvaluation, especially this is already a large company, so maybe they don't really have much room to grow anymore. So it's not a check here. Now we want the debt to free cash flow ratio under 5. This means we can pay back the debt with our free cash flow in under 5 years. So we're going to take a look at the debt we have. So we can see we have the short-term debt. We will take this number 13.45. And then we also adding the long-term debt. You can see here 25 billion. And then we're going to divide it with the free cash flow. That's 11.6. Okay, we have the number 3.314. So this means in under 4 years we can pay back the debt with our free cash flow. So this is a good number, and it's a check here. But of course they also have cash on hand, they have cash in the bank, so they have 11 billion there. So this they can also use to pay back the debt or invest more money in their business. So they have a very good balance sheet. The last thing would be shares outstanding decrease. So we have the very big company here. So it would be nice to see that they buy back shares sometime. But also we have to consider the stock price could be overvalued. So if they buy back shares, it means that they buy back shares at a high price. So we can see here they didn't buy back a lot of shares, but also not increase the shares very much. So I would still say it's a check here. I would like to give my conclusion about this company. So let's start with the good things. They have a strong portfolio. This means they not only rely on one brand, they have different brands and in different areas as well, not only in clothing, also in beverage. And this is a good thing. They also have iconic brands, especially like Louis Vuitton is very iconic. They have other iconic brands as well. And this is a good thing. It means they can have the strong value there. They also have the good financials. So we can see the revenue growth, the free cash flow growth over the 5 years. But obviously they also have the problems now in China, especially, and people in general maybe save money now because it could be the recession. And also I think maybe it's overvalued because it's already at a very high price. The stock price is still up over the 5 years and it still could be overvalued. And also it's a hype business, so it means the clothing brands get in hype but also can get unpopular again. So this is definitely a risk because we don't really know which company will be hyped in the next years and which company will lose their popularity. So this is a risk and we have to consider that as well. So for me, it's overvalued because I would like to see it cheaper to be interested, because this is a difficult business as well. So I hope you liked the video and please don't forget to subscribe and like the video.